China yesterday raised bank reserve requirements for the fifth time this year. It's part of a broader policy that also includes raising rates in order to slow the economy and limit inflation. And that policy has implications big time for investors. Joining us now with his analysis is Jim Bianco. He's president of Bianco Research. The firm based in Chicago specializes in the investment impact of global macro developments. Jim, great to have you back here with Matt and myself. First of all, in terms of what's going on in China, do you anticipate that they're going to continue to raise those reserve requirements, continue to take measures to kind of rein in the inflation that we're seeing in China?
Yes, and the way you answered the question, the question was the answer. China's got an inflation problem. Their overall inflation rate is over 5%. Their non-food inflation rate, which is kind of their core, is at 2.7%. Now, they may not sound high, but the last time our core inflation rate was that high was 16 years ago. They have to rein in their inflation problem, especially with 9% real GDP growth. And the series of reserve requirement hikes has been a way to do it, and I don't think they're done. There's going to be more.
And they're looking now at 21%. That's really a staggering number for bank reserves. Why don't they just go ahead and allow the yuan to appreciate a little bit? I mean, wouldn't that take care of the problem as well as be sort of a foreign relations maneuver, sort of killing two birds with one stone?
It will take care of the problem if the yuan actually appreciated. Now, there's a school of thought, which I somewhat subscribe to, that if they were to let it float or give it some kind of partial convertibility, there's a lot of wealth trapped in China that can't get out. And if that wealth was to give in a way out so that you could convert your net worth in China to another currency, you could actually see it decline then in that point as they had a mass exodus of capital. So it's not clear that if they were to let it float that you would see an appreciation. That's the theory that most people operate on, but it's not proven by any stretch that that's exactly what would happen in reality.
Jim, that would require a bit of some policy changes, wouldn't it? I mean, how likely are we to see a lot of capital flow out of China elsewhere?
No, I don't think you're going to, and I think you're right. The policies are designed right now to not let capital flow out of China. It's tightly controlled. They have these animals called qualified investment plans or funds, which they can let some money out, they can let some foreign money in. So it's very tightly controlled right now, and they're not about to lift those restrictions anytime soon.
What's interesting, too, you actually have Citigroup CEO Vikram Panda talking about it. He says China's constraints on sending capital abroad are driving prices higher in the world's most populous country. What are the implications, Jim, the broader implications, particularly for investors?
Well, if China wants to continue to raise reserve requirements and China wants to continue to try and slow their economy, the basic right up front is they're going to demand and buy less raw materials. You've seen it most likely or most evidently in the price of copper. The price of copper has been slumping a lot more than a lot of other commodities. It's actually down on the year. The imports of copper to China are at the lowest levels we've seen in about 18 months. So industrials, basic materials, those type of companies would suffer immediately. The second effect would be the manufacturing companies, think Deere, think Caterpillar, that are trying to sell high-end equipment that usually work in those areas as well, too. If they're going to slow down, they're going to wind up buying less from them as well, too.
What about, this morning we saw the markets come down after the reserve requirements were increased. Of course, everybody knew this was coming, right, Jim? And I mean, the markets react at the first instance, but now they're back up. Everything's cool. Is this all really priced in?
To some extent. I do think that there was a lot of cross currents this morning as well, too. The reserve requirement hike, yeah, we didn't know it was coming this morning, but we knew it was coming, and that there's been a reining in of bank reserves. But also you've got margin requirements going up on commodities. They raised gasoline margins yesterday, effective today as well. They raised crude oil margins a couple of days ago. So those are starting to play in as well, too. But in general, the bigger theme here is that we're tightening down on both economic growth in China and speculation in commodities here. And it's kind of a double whammy for the commodity markets, and that's why they've been having such a tough go of it for the last couple of weeks.
So, Jim, you mentioned this could be tough on companies such as Caterpillar. The areas, though, that you would suggest maybe investors look at as a different area that won't be so impacted by the comings and goings of China?
Yeah, if you wanted to look at areas that are completely devoid of this China argument, and you can't get away from it, but start with healthcare, start with technology, start start with the consumer sector. Even with the consumer sector, Walmart is 10% of the trade with China right now. That's not going to change with their slowing down of the economy. They're trying to slow down domestic growth, not trying to slow down the products that they make and ship to Walmart. So those areas won't be affected by it as much as like basic materials, industrials, and some manufacturing would be with a slowdown in China.
Jim Bianco, as always, good to get some time with you. Jim Bianco, Bianco Research. Thank you.